Here to answer that is Jared Woodard. He's head of the Research Investment Committee at BofA's Securities. And Jared, I'll note, everything was down yesterday except the Russells. What do you make of that?
Hey, Kelly, it's good to be with you. I think the first thing to make of it is that the trade that so many investors were hoping for in years past, that earnings and even returns would broaden out across the market, they gave up on last year. That was one of the big outflows. I think that trade is back. It's part of our forecast at BofA Research that we expect success and strength in the market to be a much broader story in 2026 than it was in 2025. And so far, the evidence supports that.
Yeah. But so to those who have been burned by this trade a number of times, is there now something, is it just a catch-up trade? Like, that's great. We're all going to kind of march along a pace as long as the AI trade is firmly in the leadership. Or could there be a stronger rotation here where something like the small caps even start to lead the way?
Well, we're very bullish on small caps for this year, but I think the key point is that the strength in artificial intelligence and broader industrial growth is something that affects almost every sector of the market now. I mean, of course, AI is concentrated in some tech stocks, but there's a very real and legitimate sense in which, some metals and mining companies, uranium miners, utilities, real estate, it's hard to think of a sector in which artificial intelligence isn't now a very relevant and key part of the business model or expectations of the future. We're seeing expansion in the U.S. economy across every component of GDP, from consumption to corporate investment. Government investment is growing in key sectors, and even trade, which has been such a sour note in the economy for so long, as most investors know now, was at the narrowest trade deficit since 2009 recently. So there's a very broad and real sense in which the hard economic data, real figures, not surveys, are showing profound strength. We have an analysis that we do on this measure, and of course the survey data is quite poor in many areas, but that hasn't been a good predictor of market returns in recent years. What's been a much better predictor is the real economic data, and on that front we're seeing some of the strongest levels in years.
Which might be why, to quote you, markets are off to a boisterous start. Precious metals up 9%, small caps up 6%, emerging markets ex China up 5%. Convertible bonds, if you want to go there. And so you're kind of saying all of the components of this are in place. You're not warning about an AI bubble. You're not saying we need it, although obviously, it's got to be part of the story. But you're just saying go to lesser owned corners of the market. And some of those, that's why we were starting with small caps. Maybe Japan, if I'm getting this right, quality and value in the U.S. You mentioned gold, although that seems, very well owned at this point, some trending commodities. So where else would you kind of be pointing people to? And do you think that what we've started the year off of becomes the trend for the duration of 26?
I think the start for this year is a very interesting tell. I think the most important thing to focus on is where companies are investing and where we see strength in the consumer and where we have policy support. A lot of investors are concerned about valuations in AI and about the incredible returns and whether they can continue. Our analysis suggests that the analogies people like to draw with past bubbles and past periods of real volatility may not be a good indicator for today. You're not seeing a kind of divergence, for example, between the returns to these stocks and the profits that they're earning. They're actually moving well in line with one another, something that wasn't true in the dot-com era. Typically, bubbles in the market burst when central banks are raising interest rates, not cutting them here and around the world, as we expect for 2026. And even the investment plans of companies, which have become so massive in recent years, even becoming a point of concern, really pale in comparison to the kinds of capex that was necessary, say in the dot-com era, which was almost double the kinds of investment that you're seeing today. Wow. I think one reason for this broadening that might be underappreciated by investors is that the tech companies realize that if they don't bring the rest of the economy along with them when it comes to utilities and transmission and scaling up industry, there are going to be some pressure points and some backlash. You've seen some deals even in recent days where companies have been willing to pay a higher price maybe for electricity or for components that they otherwise might have done in years past. I think because they recognize that using their fortress balance sheets to bring the rest of the suppliers and the industrials along is going to be a long-term winning trade.